Hello everyone. Today I am going to discuss about UPSC topic, that is in Indian economy, monetary policy in India. So in that instruments of monetary policy, important topic for UPSC and State Public Service Commission exams. So for all exams it is very important. Okay. So coming to this monetary policy in India, monetary policy is the process by which Reserve Bank of India controls money supply, interest rates, and credit availability in the economy to achieve economic stability and growth. Okay, for every controlling aspect in the Indian economy. So this monetary policy in India is very important. So in this instruments of monetary policy is very important. Mainly the monetary policy tools are divided into two types. Okay, that is quantitative and instruments and qualitative instrument. So that is quantitative that affects overall money supply, and qualitative is some targeted specific sectors instrument. Okay, and also that main type is very important for the exam perspective is that is quantitative instrument. Okay, very important for exam perspective. So under quantitative instrument, that is important is repo rate, reverse repo rate, cash reserve ratio, statutory liquidity ratio, open market operations, bank rate, and all. In qualitative instruments, moral succession, rationing of credit, regulation of consumer credit, direct action, margin requirements. Okay. Some recent development in this tools are quantitative easing, marginal standing facility, base rate, marginal cost of funds based lending rate. Okay. Let's see now overview of all these terms. What is that and all. So in this UPSC, you have to understood the term and that key term. What is the application of that key term in the prelims or main stage. Okay, we have to understood the basic in that. Okay. Now discuss about that quantitative instrument. So in this quantitative instrument, that first one is repo rate. Okay, repo rate means that is the one of the rate. Okay, the rate at which commercial banks borrow money from the central bank. Okay, here central bank means RBI. Okay, that commercial bank borrows money. Okay, from the central bank, that is used to control the inflation and the liquidity in the economy, Indian economy, right? So and also to lower the repo rate, that will increase the liquidity, while higher rate reduces it. Okay, here you can see the application, how the repo rate works. Okay, if you repo rate increases means money flow will controls, right? Less investment, inflation will control. If repo rate decreases means more flow and also more investment. So this type application questions will come in UPSC prelims or any state public service commission exams. So very important to understood the concept. Okay, in this how we have to apply that. They will ask increase or decrease, they will confuse you which one is increasing, decreasing, what happens if it increases, what happens it decreases. So all those things are very important. Okay, that repo rate and all these quantitative tools, instruments, they will almost they will change bi-monthly. Okay, bi-monthly means that monetary policy committee is there. They will review it every 2 months once and all. They will change the repo rates and all. So current repo rate for that bank is 5.50%. Okay, that is the repo rate. Okay, and next is reverse repo rate. Reverse repo rate means that is the opposite of repo rate. That is the rate at which commercial banks deposit or park their surplus funds with the central bank. For that they will get interest and all. That is usually less than repo rate. So current reverse repo rate is 3.35%. So it is also used to absorb excess liquidity from the market and also helps in controlling inflation and managing money supply. Okay, maximum quantitative tools means to control the money supply and inflation in the market. Okay, this is about repo rate, reverse repo rate. Okay, next cash reserve ratio, that is also called CRR. Okay, it is also the percentage of bank's total deposit that must be kept in reserve with the central bank. Okay, in the central bank, we have that bank can deposit the money. Okay, that is actually current is 3.3%. Okay, that the percentage of a bank total deposit that must be kept in reserve with the central bank. Okay, it is a tool to control the inflation and regulate liquidity in the banking system. Also, higher CRR reduce the lending capacity of banks, right? So that is how the RBI controls this one. Same thing, statutory liquidity ratio (SLR). That is also one tool. That is actually statutory liquidity ratio means the minimum percentage of a bank net demand and time liabilities, that is NDTL, that must be maintained in the liquid asset. Liquid asset like that is in the form of cash, gold, or any government securities, right? In that form, they can maintain in that, and it also helps to control credit growth and maintain financial stability, and also used to ensure that banks have enough liquidity for withdrawals and all. It will help. Okay. This is about statutory liquidity ratio. First, you should know what is the difference between repo rate, reverse repo rate. Next, you should know the cash reserve ratio and the statutory liquidity ratio. These four are very important for exam, especially for prelims and all. Very important. Okay. Next is open market operations. Okay, OMO. Open market operations means that is the buying and selling of government securities by the central bank in the open market. Okay, they also in open market they will buy and sell the government securities. Okay, that is used to control money supply and influence short-term interest rates. Okay, and also this open market operations is a tool for managing inflations and liquidity. Okay, maximum these tools are used for inflation and liquidity. Okay, next is bank rate. Okay, bank rate is it is also same one tool. It is the rate at which the central bank lends to commercial bank for long term loans. Okay, in repo rate it is short term. Okay, that is 14 days like that, but bank rate can be long term. Okay, it may be higher than repo rate. Okay, that is 5.75%. Okay, the rate at which the central bank lends to commercial bank for long term loans. Okay, a key indicator for setting interest rates in the economy, and also higher bank rate discourages borrowing while lower bank rates encourages it. Okay, this is the thing what bank rate is okay, current 5.75%. Okay, these are the tools, main tools, quantitative instrument. Okay, so that is repo rate, reverse repo rate, cash reserve ratio, statutory liquidity ratio, open market operations, bank rate. Repo rate is current 5.50%, reverse repo rate 3.35%, cash reserve ratio is 3%, statutory liquidity ratio is 18%. Okay, all those things. Bank rate is 5.75%. Okay, these are quantitative instruments. Okay, extra there are margin standing facility, base rate, and all I will discuss in next after qualitative instrument. Next, coming to qualitative instrument, it is qualitative, actually targeted monetary control. Okay, targeted sectors, industries, or any selective sectors, they will target or influence. In that, first one is moral suasion. That means it is an informal, okay, not formal, informal influence by central banks on commercial banks, and also no legal enforcement based on persuasion, and also encourages banks to follow policy guidelines. Okay, this is about moral suasion. And next point is rationing of credit. It is also one monetary qualitative tool, and also it limiting the amount of credit available to certain sectors. Okay, different sectors are there in the economy, right? For them, limiting the amount of credit available to certain sectors, and also aimed at preventing inflation or excessive borrowing. And also a central bank may control credit availability using interest rates and reserve requirements. Next is third point, that is regulation of consumer credit. Consumer means whoever borrows that money, right? So their control over credit offered to individuals for personal consumption, and also includes restrictions on loan types, interest rates, and terms and all. and also ensures responsible borrowing and financial stability. And this is about regulation of consumer credit. Next one is direct action. Okay, in direct action, central bank takes strict steps against non-compliant banks, and also may involve restricting operations or imposing penalties, and also used for serious regulatory violation or risk mitigation. And last one is margin requirements. It is a minimum equity or collateral required for loans, and also reduces speculative borrowings and ensures risk mitigation, and also often applied to loans against asset like shares or property. Okay, these are that qualitative instrument. Actually, more important is quantitative tools. Okay, but you should know about qualitative instrument. Exam perspective, quantitative tools are very important. Again, these qualitative instruments: moral suasion, rationing of credit, regulation of consumer credit, direct action, margin requirements, and all is very important. Okay. Next is the recent development in that 4 important points about instruments of monetary policy. That is for quantitative easing, marginal standing facility, base rate, marginal cost of funds based lending rate. Okay, that is first is quantitative easing. Quantitative easing means it is an unconventional monetary policy tool. Okay, used for central bank to stimulate the economy when standard monetary policy such as they will lowering the interest rates and also become ineffective. Okay, typically when the interest rates are already near zero, right? So that time they will use, and also some central bank purchases government securities or other financial assets from the open market, injecting money into the financial system. So it will help for the Indian economy. Okay, and also it will purpose is to stimulate the demand and also increase the liquidity in the market and also boost asset prices. Okay, these are the purpose of this thing. You can see the example, that is US Federal Reserve, right? That used it extensively after 2008 financial crisis, and also during COVID-19 pandemic to combat low inflation and economic stagnation. Okay, where they used this one. Next is marginal standing facility. Current marginal standing facility is 6.75%. What do you mean by marginal standing facility? Marginal standing facility means it is a facility provided by the Reserve Bank of India that allows commercial bank to borrow overnight funds from the central bank, but a higher interest rate than the repo rate. Okay, higher interest rate than the repo rate what the from the central bank that the commercial bank will borrow. Okay, it is when bank is facing a shortage of liquidity, can borrow funds from the RBI through marginal standing facility. It is the purpose to provide emergency liquidity support and also to stabilize the financial system. Example we can take: during periods of high market volatility or liquidity crisis, Indian banks may resort to the marginal standing facility to meet their short-term funding needs. Okay. Next is very important, that is base rate. Base rate is the minimum rate of interest set by commercial bank to below which they cannot lend to their customers. Okay, cannot lend to their customers. It is determined by the individual banks based on their cost of funds, operational cost, and RBI's policy rates. How it works means that bank sets their base rate considering their cost of funds. It is around 7.25% to 10.10%. Okay, in between that base rate will be there. And also purpose is to determine the minimum lending rate and also ensure transparency. Okay, for that purpose it is very important. Next is the last point, that is marginal cost based funding. That is the marginal cost funds based lending is a new benchmark lending rate introduced by the RBI in April 2016 to improve the transmission of monetary policy to replace the base rate system. It is purpose to make loan pricing more responsive and to improve transmission of monetary policy. Okay, so this is about quantitative instrument and qualitative instrument. Go through this again and again. You will clearly understood about all these monetary policy instruments. Okay, so thank you, and support me for further videos so that I can analyze every topics in the UPSC for you. Okay, thank you.